So Toronto's Real Estate Market Watch shows home prices up 3% year over year. But at the same time, power of sales are up over 400% and new listing volume is increasing rapidly while home sales plunge. Also, the pre-construction home market is absolutely on life support. It is dead quiet out there. So let's get into some of the data. Hey, Jordan here from Condo. Welcome back to the channel. And if you're new here, please subscribe. There's a lot of conflicting data out there. So I wanted to take some time and go through a full market update, everything from resale homes to resale condos to pre-construction homes. So let's go through this one chart at a time. If you like data, this is a video for you because there's a lot of it in here. So let's start with the Market Watch. Every month, the Toronto Real Estate Board releases this. And I just want to highlight two data points here. So first off, average price showing 3% increase year over year. Number two is sales volume. This is more interesting to me. So sales volume for September of 2023 was 4,642 sales. Roughly the lowest number for September in like 21 years, okay? Very low. More interestingly though, is that it's actually lower than August sales numbers. That is incredibly rare, right? August is typically the second slowest month of the year because people are on vacation, they're doing things, they're living life, enjoying the summer. They're not looking at buying and selling homes. Obviously, generally you see things pick up September through November and then die off for the holiday months. Didn't see that this year, okay? Incredibly rare for sales volume to decrease in September and just speaks to the sentiment of the average home buyer out there. So power of sales are up 400%, okay? With power of sales, lenders are obligated to sell at fair market value, okay? They have to, or at least they have to try. And so as a result, they're not really exceedingly good deals or anything. They're listed on MLS just like anything else. And oftentimes, paradoxically, because they're marketed as power of sales, they often get more eyes on them because people think they're going to be really good deals. And so oftentimes, they're not. They're not anything special. And the other important note here is, yeah, on a percentage rise, historic, right? A 400%, 350% increase in power of sales. But you're talking about going from like 30 to 150 listings. You're still way under 1% of the market. So it is something to watch. It's a concerning trend to watch, but it's not like this massive flooding of people not paying their mortgages and having their lenders initiate power of sale. It's still a very small segment of the market, mostly relegated to B lenders. Now, inventory is surging as well. So when you look at the blue line here, it's the current number of all residential listings on the MLS, on the Toronto Real Estate Board. You can see the seasonal target here, and you can see that we are just absolutely ripping up and to the right. Tons of listings coming on the market, and at the same time, sales volume is falling. So August into September, listing inventory picking up rapidly, but sales volume declining. You're also seeing a market increase in rental listings. And a big part of the reason for that is because people aren't getting what they want in terms of price on the resale market. And so a lot of them are just saying, if I can't get $2 million for my home, well, I'll just lease it out for a year for $6,000 and wait and hope the market improves, right? So you're seeing a lot of that as well. And so rental inventory is ticking up as well. Now, zooming into months of inventory here. Months of inventory is a distillation of if we are in a seller's or buyer's market. Scott Ingram does a great chart here that breaks down the 416, so Toronto proper, condos versus freehold. And you can see that condos are not faring as well as freehold. So freehold's actually tightening a little bit. The reality is this week, when he releases this chart on Tuesday, I bet you see this come back up to 3.5, 3.8-ish. But the reality is that, freehold are faring far better in Toronto than condos currently. Condos north of 5 months of inventory, you are firmly in buyer's market territory, okay? So condos are currently in buyer's market territory. Another way to look at the general heat of the market is sales to new listings ratio. It's exactly what you would expect. It's the amount of sales you're getting versus the amount of new listings coming to the market. And we are currently at the lowest level of sales to new listings since the great financial crisis. I see a lot of people, especially realtors, talking about how prices haven't fallen. I don't know where people get this stuff. I genuinely don't know where people get this stuff, all right? I'm not a doom and gloom type of guy. Look through my past videos. If you guys are familiar with my videos, you know I'm probably one of the most bullish people on the future of Toronto. However, things are bad, okay? This market is not good, right? That's the reality, and I think anybody who says anything else is kind of lying to themselves. You can see home prices came off 15%, and then they've come off a little bit further since then, right? So today it's worse than in February. The reality is we've already seen a pretty monumental correction in prices, and I don't think it's going to get any better over the immediate term future. Zoocastle recently put out a great infographic. You can pause or I'll put the link in the description. We won't go through all of this, but it basically took the average sale price versus the average listing price. And obviously we are today in a very different situation than 2021 where homes were selling 20% more than what they were listed for. Today you look at Oakville, the average sale price is 24% below the average list price. Toronto, 18%, Newmarket, 20%. And also this kind of just points to distribution of sales, right? So you can see that, the higher priced properties they're sitting. Whereas the lower sort of entry priced product, those are the ones that are kind of selling. So, when you look at months of inventory in freehold in Toronto and you see, it's kind of coming down, a lot of that is relegated to sort of the starter product. The starter product is doing pretty well if it's priced well. Again, not a doom and gloomer here, but the reason that I think, this isn't going to get better in the immediate term future. So if you're thinking maybe I'll wait to list till later in the fall, whatever the case is, I don't think it gets better. Right? Certainly not this year. And the reason is because of obviously interest rates and mortgage renewal. So interest rates are in the driver's seat. Yes, underbuilding and immigration over the long term is a very bullish signal for the Toronto real estate market, but that doesn't matter today. What matters today is what's it cost to buy a home? What's the servicing look like on that? And the affordability today is way worse than it was at peak, even though prices have come down because interest rates are so much higher. And this also is a big question mark for me. We don't really know how this is going to play out. The reason I say it's a question mark is because I know I pay a lot of attention to the real estate market. If you're watching this video, you probably pay a lot more attention to the real estate market than the average person. Most people don't think about real estate very much, except for when it's time to buy or sell, right? And the average 8-year gap in between buying and selling homes, they don't really think about it that much. So they know interest rates are up, but the question is, does the average person know how much their payment is going to increase at time of renewal? I don't really know if they do. So if you look at the amount of mortgages renewing within the next year, you have TD at 9%, Scotia 13%, CIBC 16%, BMO 10%, and RBC at 18%. To put this into perspective, just rough numbers, let's say, you have a mortgage from 4 years ago or whatever at about 3%. Let's say it's a $600,000 mortgage. You're at $2,840 a month. Okay. If you come up for renewal and you renew at 6.5%, that payment goes up almost $1,200 a month to $4,020 a month, or roughly a 40% increase in your payment. So I guess the question here becomes, how many people are going to be forced to list and sell their home as a result of their payment increasing 40%? How many people can absorb into their monthly budget that 40% payment increase in their primary home? I really don't have the answer to this. And that's why this is the question mark for me, because when you look at what the market is pricing in for expectations on interest rates, you can see that the first expected rate cut currently is for September of 2024. That is almost a year away. People that are far more educated on this than me have always said that rate hikes take 6 to 12 months to work through the system. And so we're kind of getting to that deadline today. Now let's zoom in a little bit to my favorite asset class, condos. So if we look at the 416, so Toronto, everything from Etobicoke over to Scarborough, you look at condo resale prices per square foot, you can see that from 2020 through 2023, they've risen quite considerably. The reason for this is because outskirts condos have done really, really well, right? So your Humber Bays or just Etobicoke as the whole, your Scarboroughs, they have risen rapidly in per square foot values. It used to be before the pandemic that you would get a 20-25% discount for living in Humber Bay, for buying a condo in Humber Bay versus buying a condo in downtown Toronto. Now that gap is almost zero. It's like $50 to $100 a square foot difference. And so that's why this chart looks the way that it does. But when you look at a downtown neighborhood, King West, for example, and you look at the per square foot selling price there, you can see that from 2020 through 2023, prices are almost flat. You're talking about $1,050 to $1,100 a square foot. So a 5% increase in per square foot selling values. But at the same time, pre-construction listing and selling prices have risen considerably through that time. So I took one quick example here from a building in the entertainment district, 87 Peter. And if you look at the per square foot sales data at that building, you'll see that in 2020, it was averaging just over $1,150 per square foot. Made its way up to $1,350 per square foot in 2022. And today it's trading just under $1,300 a square foot. Where this gets a little dicey is the fact that there are projects that launched in 2020, one of which launched at $1,500 a square foot. We'll call it Project C. I'm not going to call any development out by name here. This building was a very quick build, actually super impressive how fast this got built. It's going to be completing end of this year or early next year. And so people are going to be taking delivery on their units in the same neighborhood as 87 Peter for $1,500 a square foot. That's what they paid. And the resale market's hovering around $1,300 a square foot, which is a $200 a square foot or a 16% premium. So in talking about the pre-construction market, how does it look out there? Not good. As someone who sells pre-construction all day, it's really bad. It's incredibly slow, right? I expected it to actually be worse. I'm surprised we're even running at 50% volume given where rates are, given where resale market's at, and given how distressed the assignment market is. I'm surprised we're running at 50%, but that's where we are. So if we look at freehold pre-construction sales year to date, we're at 4,184. The 10-year average, so not the 2021 average, but the 10-year average suggests we should be at about 8,000 sales year to date. We're at about half. If you look at condos, it's no better, right? It's roughly the same. So 8,779 sales year to date. Look at August, right? Less than 500 pre-construction condos across the entire GTA got signed in August. So 8,800, 10-year average, 15,000. So again, you're talking roughly half what we would expect to see. This is bullish. Hear me out. So we are short housing in Toronto. That is no secret. We're short housing in the whole country, basically. We were short housing over the last 10 years in Toronto, despite immigrating around 200,000 people. We are now immigrating far more. And at the same time, we are pre-selling far fewer homes than we historically did. In order to complete a home, you first have to start it. In order to start it, you first have to sell it. Sales are at 50% of 10-year average. Immigration is double 10-year average. Okay? That does not bode well for affordability in the near future. But the reality is, none of this matters over the next year or two, right? Your 5-10 year projection, sure, looks great, right? But over the next year or two, realistically, I only see more pain in the market. And of course, people are finally noticing this. You have CMHC updating their targets for housing. You have people like Toronto Star running articles. Canada's gap between home building and population growth has never been wider. And that's part of the reason you're seeing rents just absolutely rip. You see immigration go up. You need more rental supply. There isn't more rental supply. You know, in the GTA, we complete 25, 30,000 units a year, no matter what. You double the amount of inflow and you're going to have problems on the rental market. So that's what we're seeing here. I recently presented at the Veritas conference talking about the risks to the pre-construction market as I see it, sort of the three doors here, just in time for Halloween. So we've got the assignment flippers, we have mortgage qualification, and we have appraisal values. These are the three things that worry me about pre-construction. Let's get into it. Assignment flippers. So these are people who bought pre-construction 4, 5, 6 years ago. They never planned to close. They always intended to sell that contract for a profit before final closing of their condo. This is an issue because they are relatively low liquidity. Generally speaking, they cannot be listed on MLS, which means it's also impossible to get any level of accurate data on these things. But I can tell you, look, there's way more of them available than any time in history. Probably 2 or 3 times more condo assignments today versus what you would have seen 2 or 3 years ago on building completion. In some cases, you're seeing people sell their assignment condos for original purchase prices in 2019, sometimes even in 2018. And those units that are good deals like that are selling, right? They are catching bids. They are moving really quickly. If someone's willing to price very low, it will get sold. There are buyers out there. But a lot of people obviously don't want to do that. They want to recoup their whole deposits plus costs. You know, that might not be the reality depending on when you purchased. Now, we've always had assignment flipping in Toronto, but the volume of people purchasing to assign their units has increased dramatically in the past 5 years. And the reason, in my opinion, why that's happened is because people who have assigned their condos in the past 4 or 5 years have made hundreds of thousands of dollars doing so. This chart takes a look at various projects in Toronto, the year that they launched, the price that they launched at on a per square foot basis, and what they sell for on the resale market today. So just as a quick example, if you bought Kingsway by the River in 2016 at $563 a square foot, and then in 2021, you assigned it for $900 to $950 a square foot, you would have made $100,000, $150,000, $200,000 on your unit that you never took possession of, never took a mortgage on, never bothered to get a tenant on. That's an amazing return on investment, and that's why so many people got interested in assignment flipping. But as I've said a million times on this channel, buying solely to assign with no plan B, i.e. being prepared to close on the property, puts you in a very precarious position in a market like today when things haven't necessarily gone your way. Now, the good news is assignment flipping still represents less than 10% of the pre-construction market, right? Even in today's market where interest rates are super high, people are having to close on their condos in negative cash flow positions, you're still seeing less than 10% of a building list for assignment, which means, when a 400 unit building is closing, you're seeing 30, maybe 40 units on the assignment market. Traditionally and historically, you would have maybe seen 5 to 10. So now you're seeing a lot more, still less than 10% of the building, not some massive systemic risk, but it is something to watch. Door number 2 is mortgage qualification. So if you've bought a pre-construction condo before, you probably know that you have to provide the developer with a mortgage pre-approval letter. Now, this is provided at the time of purchase. So if you bought 4 or 5 years ago, you'd be qualifying at a much lower rate. The question becomes, can you still qualify based on your income and debt at today's mortgage rates? I would imagine some people just can't. And then the door behind door number 2 is, what if you bought multiple units? So here's an interesting fact. If you buy, let's say you have the income to support your primary and a $500,000 investment condo. So you go out and buy that $500,000 investment condo and you go get a mortgage pre-approval from, let's say, Scotiabank. And then the next day you decide, you know what? I want to be a real estate tycoon. I'm going to buy 2 more. So you go buy 2 more $500,000 condos because you have the cash available. And all the developer cares is that you get a mortgage pre-approval and you have your 20% down. Okay, cool. You buy those 2 more units. And instead of going back to Scotia, for the second condo, you go to TD. And for the third condo, you go to BMO. None of them know that the other purchases exist. They are isolated. As far as BMO knows, you bought 1 condo. As far as Scotia knows, you bought 1 condo. They don't know about the other purchases, right? So realistically, you only qualify for the 1 mortgage, but you got 3. That's going to pose a problem when it comes to close. And then the final point is appraisal values. We touched on this a little bit earlier with the King West condo example. The question becomes, if your condo is not worth what you paid at time of closing, you have to come up with the cash difference to keep your loan to value at 80%. Now, the reality is this is something we've seen in the freehold market already, right? We saw it in 2017 with some subdivisions in Oakville and Vaughan, where the freehold properties that people bought were not worth what they paid at time of closing because the resale market corrected in the interim. It's more common in the freehold market because they're built on much shorter build cycles, and condos have been more isolated from this risk because they take 4, 5, 6 years to build, sometimes longer. And so the market generally makes it to at least what you paid, historically much more than you paid. So by the time you close, you have no concerns there. But of course, when the condo market hasn't really appreciated in some neighborhoods, specifically downtown Toronto, for about 3 years, well, that sort of starts to become a question mark. Bullpen has a great chart for this. This was a condo building that launched in Etobicoke in 2017. It's still not done today. But you can see the average price per square foot over time at that building. You can see that in 2017, they were at $800 a foot, then at $845, then at $1,100 a foot. In the specific neighborhood this building's in, new buildings can trade for up to $1,100 a foot. So you can see kind of here that anybody who bought a unit there 2019 and prior, they're going to be fine on closing. But it gets dicey 2020 onwards. These people are not going to be fine. They're going to be in negative equity scenarios. The good news is 80% of these deals would have been signed in 2019 or earlier, because in order to break ground, you need to pre-sell to a certain threshold. And so most developers front load their deals, right? So those people are going to be fine. So here's another illustration of this. If we look at the Church Street corridor, there's a building there, 85 Wood. You can see the price per square foot, selling value here in blue. Today we're at $1,280 a foot. And if we just assume for this chart's purposes that the resale market stays stagnant, sideways into the future, doesn't come down, doesn't go up, at $1,280 a foot, these are 2 projects that launched in the neighborhood. One launched in 2020, Project A, at $1,350 a foot. One launched in 2021 at $1,415 a foot. They're closing in 2024 and in 2025. So you can see here that, this building, Project A, I'm not really concerned with. $1,350 a foot, $70 a square foot above resale, but the resale building's a few years old. So at a 5% spread, it's likely that those units appraise. It's likely that these people are able to close no problem. It gets more dicey when you're above a 10% spread. That's when appraisals start to come into question. And so you either have to have the cash on hand to make sure you can close on that property, or you risk defaulting. Now, if you default, you walk away from your deposits. The developer can sue you for damages, but in the case of an 11% spread, there wouldn't be any damages because your deposits exceed the amount of damages on the lower resale of the unit. But in the case that you put down 20% and there was like a 30% spread between resale market value and what you agreed to pay for your condo, of course, in that case, there might be damages. But the reality is, I'm not too worried about this because I think, if people default on closing and walk away from their deposits, Most developers, given the current rental environment, will just take out inventory loans on the product that didn't close and lease those units out until they want to resell them at a later date. So I think it's more of a consumer problem than a developer one. But again, in a market like this where pre-construction sales volume is so low and developers over the past few years, especially smaller, newer ones, have maybe levered up and bought too much land at too high of a value, I think it's inevitable that in a market like this, if this continues, you're probably going to see some smaller and mid-sized developers go belly up. And I think that's probably for the best, just a little bit of an industry cleansing, not just in the realtor section where you're definitely going to see realtors leaving the industry on this low volume. I think you'll also see some developers have to fire sale their land, which will get gobbled up by the bigger players at lower values. But yeah, I mean, it's just something to watch. Let me know what you guys think in the comments below, and I will see you guys next video.